Good morning, everyone. This is Marshall Gidler bringing you the morning comment for January 22nd. Well, falling commodity prices and the risk of deflation are causing central banks to change their monetary stance. Yesterday, we saw three central banks, the Bank of England, the Bank of Canada, and perhaps the ECB, dial down their monetary stance and move to a looser policy. These same factors are affecting central banks all over the world, so we can look for similar moves from other central banks in coming weeks. And as these looser policies, taken for domestic reasons, have external spillovers, we can look forward to a resumption of the currency wars that were so much a topic in the FX market before the Fed started talking about tapering off its quantitative bond purchases in May of 2013. Well, the day started with the Bank of England's retreat. Previously, 2 of the 9 members of the Monetary Policy Committee had been voting to raise rates. Yesterday's minutes, however, show that the vote is now unanimous to keep rates steady. Next was the ECB, as the Wall Street Journal and Bloomberg floated stories to the effect that the ECB would discuss a program of buying 50 billion euros in bonds every month. The Journal said the program would last 1 year, while Bloomberg said around 2 years. Finally, the Bank of Canada surprised the market, but not our readers, with a 25 basis point cut in rates, the first change since it hiked rates in September of 2010. Now, Governor Polo's comments afterwards mentioned oil prices 14 times. He also noted that, quote, the bank has room to maneuver should its forecast prove to be either too pessimistic or too optimistic. I think their oil forecast is likely to be wrong and that they will have to cut rates further, which is why I remain bearish on the Canadian dollar. Now, the market immediately started speculating on who might be next to cut rates and turned its attention to the other commodity currencies. The Aussie and Kiwi sank, and frankly speaking, the technicals look pretty bad for both of them. For today, of course, we're all waiting for today's ECB meeting. The size of the bond purchases will be more important than the duration because they can always extend their program. Anything less than 50 billion euros a month for 1 year, or 600 billion euros total, will probably now be disappointment and cause the euro to strengthen. The market will also be looking to see whether they go for mutualization of risk, that is, whether the ECB itself will buy all countries' bonds, or whether each national central bank will be responsible for buying its own country's bonds in an effort to avoid sharing risk. The mutualization of risk will be a much bigger show of solidarity within the Eurozone and therefore a stronger statement. But personally, I think they'll probably go for non-mutualization in order to get the northern countries on board. It's widely expected that the amount of each country's bonds to be purchased will follow that country's contribution to the ECB's capital, its so-called capital key. They'll have to decide what credit ratings they can buy and whether to buy Greek bonds. I expect them to be excluded. Other points to watch will be whether they include EU agency bonds and corporate bonds. Finally, it'd add to the psychological impact if the vote is unanimous, while a majority vote, which I think is more likely, to be honest, would send a weaker signal of commitment to easing. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.